The cheaper AI gets, the more you're going to spend on it. Hi, everyone. Welcome back to Next Move Banking. I'm Virginia Heyburn, Principal Strategist with Engage FI. Last week, I laid out what I'd negotiate in a core contract because the language that decides what you're allowed to build matters more than the pricing schedule. And I close with a warning. Cheaper technology can quietly produce a bigger bill. Getting the contract right doesn't retire the risk. It moves it out of the vendor's paperwork and into your own consumption. This is the fourth of my 5 predictions, and it's the one I hear discussed the least in the market. The institutions that get the most value from artificial intelligence won't be the ones with the best models. They'll be the ones that manage the economics better than everyone else. Cheaper doesn't mean less expensive. That sounds counterintuitive. If AI becomes dramatically cheaper, shouldn't institutions spend less? Well, history says otherwise. In the very first episode of this series, I gave you the pattern. Storage got cheaper, so companies stored more. Bandwidth got cheaper, so companies transmitted more. Now, let me bring that pattern home to banking. Think about online banking. When customers first began banking online, each interaction became less expensive than handling the same transaction in a branch. But the savings never showed up the way anyone modeled them because customers didn't do less banking. They did more of it. A customer who saw a teller twice a month today checks the app every day, maybe multiple times a day. Mobile banking arrived. Again, the cost of an individual interaction fell. Again, customer activity increased. Lower cost didn't reduce demand, it expanded it. I think artificial intelligence will behave exactly the same way. As the cost of using it falls, institutions won't simply perform today's work more cheaply. They're going to apply intelligence to more decisions, because that's really what is going to be required to be competitive in the marketplace as a financial institution. And this is where I part ways with the headlines. Every article I read says that falling AI prices are good news for community banking. I think falling price is the trap. Hear me out on this. The cost of an individual AI model may continue to decline, but the work you're asking it to perform keeps expanding. What begins as fraud monitoring becomes fraud monitoring, pricing support, maybe deposit attrition analysis, document review, commercial lending assistance. The list goes on, right? It could be policy checking and, of course, customer service. And eventually, those decisions won't rely on one model. They'll involve several systems working together, retrieving information, checking policy, reviewing documents, producing recommendations before a banker ever sees the result. You see how these lists expand? Each individual step gets cheaper, but a more capable decision uses more steps. And a more capable institution points intelligence at more decisions. That's why your total consumption can grow faster than the price of the underlying technology falls. The cost of each decision falls, but your total technology spend rises. Both are true at once, and that's the trap. AI doesn't stay expensive. It becomes cheap enough to use everywhere, and everywhere is what you end up paying for. Most technology risks in banking punish the institutions that hang back, but this one is different. It catches the institutions that use AI well. Picture the institution that does everything right. It negotiates the stronger contract. It modernizes the architecture. It ships a fraud capability that actually works in real time. And word travels inside a bank the way word about useful things always does. Lending once in, deposits once in, 18 months later, what started as one use case is quietly embedded across half the institution, and the technology is doing exactly what everyone hoped. Then budget season arrives. Technology spending has grown faster than anyone expected, and the board asks a perfectly reasonable question. What did we get for the extra money? And a lot of institutions won't have a great answer. The technology didn't fail. Nobody built the discipline to measure what those decisions were worth. Some AI projects will genuinely fail, but many successful ones will be shut down for a different reason. Without measurement, healthy adoption and runaway spending look exactly the same. The capability worked, but the governance didn't. Banks have measured efficiency ratio, cost of funds, cost per loan, cost per account for decades. And I think they're about to measure something else, the cost per decision. Not every decision deserves the same level of intelligence. Think about a low-risk process. That shouldn't run on your most expensive models every time it executes. You already manage this way with people. You don't assign your most senior lender to every consumer loan. AI deserves that very same discipline. The institutions that perform best will match the cost of the intelligence to the value of the decision, and they'll manage AI the way they've always managed every other operating expense. I don't think every bank needs a new executive with AI in their title, but every institution will need someone responsible for understanding what its intelligence costs, where it's being consumed, and whether the value justifies the expense. Invoice review is accounting. Managing consumption is strategy. And the institution that builds this discipline can walk into that same budget meeting with an answer. We spent this much making fraud decisions and fraud losses fell by that much. We spent this much watching for deposit attrition and we kept that much in balances. That's what a good answer sounds like. Cost on one side, outcomes on the other. Cost per decision will become a standard management metric over the next several years. So where do the economics go next? Everything so far has been about your side of the meter, but there's a second half to this. Economics rarely disappear, they simply relocate. As the cost of leaving a core system falls and institutions gain more flexibility, the providers will naturally look for new recurring sources of revenue. So we have to pay attention to how new capabilities are priced, not just what they do. If more revenue begins flowing through AI subscriptions, usage-based services, or per-decision pricing, we can't dismiss that as a product announcement. It's an economic signal. The moat may be simply moving somewhere else. If you control the intelligence layer as a bank, you keep the flexibility to choose among models as the market evolves. If every capability depends on one provider's meter, then you've recreated the dependence you were trying to escape, only now it's variable. So let me leave you with 3 thoughts. First, understand that a growing AI budget is ambiguous. It can mean adoption is accelerating, or it can mean spending is running away. The number alone cannot tell you which. And when a board can't tell healthy adoption from runaway spending, it assumes the worst. And that's not a board failure. That's where responsible boards really engage, asking about unexplained cost. Second, decide who owns your cost per decision before the first model goes into production, not after the first invoice, before deployment. And finally, watch pricing models as closely as product announcements. Products change every quarter, business models rarely change. So when a provider's pricing model starts to move, it isn't noise, it's the strategy announcing itself. Nothing will tell you more about where the market is headed than that. Over the course of this series, we've removed almost every reason community banks have been told they can't compete. The core banking market is changing, Advantage is moving above the core, better contracts preserve your options, disciplined economics keep them funded, which leaves one final argument: talent. Next week, we'll look at the assumption I hear more than any other, that community banks simply can't hire the people they need to compete in today's environment. I don't think that's the real problem anymore, and I'll show you why. I'm Virginia Heyburn, and that's your next move.